Is your company going through a tough time and you're wondering if you can live on your bounce back loan? Well, in this video, I run you through that exact scenario. As a business accountant, my team and I spend all day long helping business owners on their journey. And a common question we're getting asked and we're seeing online is around, if I've taken a bounce back loan into my limited company, can I take some of it out to live on? Now, before I answer that question, if you enjoy this video, make sure to click on the subscribe button below and you'll be notified whenever we release more just like this one. So the answer to the question is practically yes, of course you can. It's physically possible, right? You can log onto your bank account, you can transfer the money out of your limited company account into your personal bank account. So it's physically possible. Nobody's standing over your shoulder saying you can't do it, you can do it. However, what I want you to be really wary of is causing yourself a future tax bill. Now, the way this happens is if you imagine your company's taken a loan out, if you then take the money out of the company and it doesn't have the ability to pay that money to you, the only way to treat that really is as a loan that's repayable by you to the company. Now, if your company's fairly healthy and it can pay you dividends, so there might be reasons that you just don't physically have the cash, but on paper the company's got money. So let's say you've made massive sales and I don't know, you've got 200 grand that's owed to you right now, but your supplier's sitting there holding it, but you're sure it's coming, it's just cash flow. Then you bring in that, using that cash that's come in the bounce back loan to pay yourself a dividend as you normally would and live on, that's fine, you know, there's no problem with that. You do all the normal things you would do. The issue we're seeing more commonly though, is that the company is really, really tight for cash. There's no real money in it. And in fact, all the funds have been drained out of the company. Sometimes the company is overdrawn anyway. The director's drawn all the tax money out of the company, for example, to live on. And in that situation, you bring in a 50 grand loan, for example, into the company and drawing that money is going to cause you a tax bill later on. And the point where that tax bill is going to be caused is 9 months after the company year end. And I'm going to talk you through that in a minute and just show you how actually it works from a technical point of view, so you can just have a bit more of a deeper understanding of the things that are going on inside there. But if you think I'm going to get a 32.5% tax bill potentially on the money that I've borrowed from the company to live on at the end 9 months after my company year ends, not the tax year, the company year end. Bear that in mind and we'll run through the main points in the video. So this here is a balance sheet, or it's a mock-up of one anyway. Excuse the fact that it's just bashed out quickly in Excel, but it allows us to play around with it so I can show you. So this is really understanding your numbers at quite a deep level. So it's something that, bear with me, is a little bit technical, but I think it's really important to understand. So balance sheets, as they're known, or these days they're called another name, but most old school accountants will still refer to them as balance sheets. When you submit your accounts to Companies House at the end of the year, normally you've done a cut down version to stop everybody else seeing what you've actually earned, but this goes on there and this is sort of the overall position of the company. Now there's a couple of key things I just want to talk you through here in this example. So this person has taken out the maximum bounce back loan of £50,000. You can see it here, and it's a liability, so it's money that's owed back to someone at some point. And as you can see, it's the company's money. The company, it's in the company bank account there. They already had 10 grand in the account and they banged the other 50 grand in there. Now, if you imagine, so they've got 60 grand, well, £60,100 of assets. The other 100 is some money that's owed to them. So they've raised an invoice for somebody and it's not been paid yet. But they owe 50 grand in bounce back and they owe just over £5,000 to the revenue. So if you imagine if they used all that cash right now to pay everything else that they owed, they'd be left with £5,000. A simple maths, right? 60,100 left less 55,100 equals 5 grand. Now, what that really means is the pot of money, as we would refer to it internally here, is about 5 grand. It's broken down into some money that they call share capital. It's you putting your money in for your shares of the owners of the company, but realistically you've got about 5 grand there. So I'm going to loosely use that 5 grand figure. So you can see, so this little highlighted figure here, that's really, if that company shut down today, that's what would be left at the end of it for you as the owner. And we're going to presume you're the owner and director here. Now I just want to show you what happens if you then decide to pay some stuff out of your bounce back loan. So here we've paid some stuff out of the bounce back loan. In this case, the person who owed us £100 has paid us, and we've used some of the bounce back loan cash to pay HMRC, and that's something we've seen a lot. So clients have gone, cool, let's just get the tax man out of the way. As you can see, nothing's changed. We've still got 5,000 left in the pot because all we've done is taken some money, the £5,000 of cash and the £100 we're owed, and paid off the liability. So nothing's moved. We've still got the same thing. If we shut it down today, you'd have 55 grand in cash to pay 50 grand loan off, leaving you with £5,000. Now, big question, if you decided to live on something. So if you decided to live on 2 grand a month, let's just take that. It's a fairly standard amount a lot of people like to do. So £2,000 a month, it's 24 grand over the year. So you can see now we've taken this forward a year to look at the situation. Now in this particular thing, all that's happened is the cash has come out of the bank and it's not been dealt with in any other manner. So at the moment, the only way you can deal with that money, unless you were to put through some salary and pay horrendous amounts of tax on it and things like that, then you've lent it to yourself as the director. So that's why actually now we're still showing £55,000 of assets, but that's because 24 grand of it, the 2 grand a month you've borrowed, is showing as you're going to pay it back to the company. And that's the default way of dealing with it, is if there's no other way of it coming out in your name, then you owe it back. You've just borrowed it for a temporary period. And that's okay, but when you get, as I mentioned at the start of the video, when you get to 9 months from this date, the 31st, so in this particular instance, their company year end is the 31st of July, when you get 9 months later, if that balance is still outstanding, you will owe some money on it. Now, there's £5,000 available on paper still that was actually available funds. Retained profit, they call it in this particular case. So you can have some of that being dividends. So if I show you, if we did this and we went, okay, so we're going to use £5,000 of our pot for dividends. So it's reduced that from 24 grand down to 9,000. It's there. Now, that's completely fine. Or in this case, we've done 4,999, but just call it 5 grand. And it's reduced the amount owed by you as the director. So it's a paperwork exercise, no cash has moved. All it said is the accountant has said, okay, well, of the leftover profits of this original cash, which is really, if you think about it, part of the original 10 grand that was in your bank account, we're gonna allow you 5 grand of that. The rest of the money you've taken out, that bounce back loan cash, is owed back from you. And as you can see, if it reached the 9 month point, 32.5% of it would be due to revenue and customs. So you can see you're gonna pay nearly 6 grand on the 24 grand that you took out originally. And it's based on the balance of this loan at the year end. So you can see 6 grand's worth. Now, it's a holding tax. So if you subsequently get loads of profits later and are able to declare some dividends to wipe out that value of money, then fine. And eventually that money will come back to you. It doesn't come back quick. It takes a long time. And this presumes that you're going to generate enough profits and be able to live on the current money. Because if you imagine, you're still going to want to draw money to live on even when you start making profit again. So it's not as easy as it seems to suddenly start declaring dividends to wipe this out. So that is the tax trap. The tax trap is you can get caught by having this money still left in your account and living off of it. It's okay if your company's healthy. Going back to the original thing, if this was, you had more cash or more other things and this was actually a lot higher figure, let's just say this was £30,000, then you'd have enough on paper to be able to use the cash from the loan and still be okay, because you could just declare it as dividends. This generally works if the money you were owed, let's say you're owed, as we said, a big amount of cash at the beginning that you just weren't getting paid, then your pot of money would look a lot higher because the accounts presume that money is going to come in at a later date. So it's okay to use the money in the short term if you had it coming in, but where you tend to get the problem is where you end up living on this amount. So there you go. That's the technical, a quick look at the technical issues around borrowing and living off a bounce back loan. So as you can see, how this affects you really depends on your exact situation, how your company's doing, what other income you've got, and all sorts of other factors. So do make sure to check with your current accountant and have a chat with them. If you've not got one, or if they're not doing a particularly good job of it, you know where we are. You can get in contact with us on the details below. If you've enjoyed this video, be sure to share it with your friends and your network. For more tax saving tips, be sure to check out our website at healandassociates.co.uk and sign up to our newsletter. Until the next one, we'll see you there.